Young Wolf Media.
The bet that changed investing. Welcome to Young Wolf Media, and today I'm going to talk about the bet that changed investing and how it will change your view of investing and make you see that investing isn't just for the elites. Warren Buffett publicly stated that over a period of 10 years, by picking only one share, he would outperform any hedge fund in the world, and he's willing to bet $1 million of his own money on this. Now, hedge funds are supposedly able to beat the market. For those of you who don't know the legendary investor that is Warren Buffett, he is an OG of investing. He is one of the wealthiest people in the world. He's worth $88 billion. And he's also known as the Oracle because, yes, he is that damn good at investing. For those of you who don't know, Oracle basically means a person that can see into the future. His business, Berkshire Hathaway, is a conglomeration of investments he'd made in a number of different companies. He owns shares in companies like American Express, Bank of America, Apple, Coca-Cola, and many others. And he wholly owns businesses like Duracell, Dairy Queen, Fruit of the Loom, and Long & Foster, and many more. Berkshire Hathaway has averaged an annual growth of 19% for shareholders since 1965, when compared to an average growth rate of 9.7% for the top 500 businesses in America over the same period of time. As of February 2019, Hathaway is the fifth largest company in America, and it's famous for having the most expensive share price in history. A Class A share of Hathaway will cost around $300,000, which is about the price of a house. So as you can now see, many hedge fund managers were not willing to take on a bet from this titan of the investing world. It would be like this guy challenging you into a fight. This picture is of Jeff Monson, and for those of you who don't know, he's a former MMA fighter. He fought in the UFC, and he has a record of 61 wins and 28 losses, and he's also fought for the UFC title. So I think most people are like, yeah, you kind of got to know your limits. So nearly a year went by before anyone took him up on this challenge. And it was only one brave hedge fund manager that took him up on this challenge. This manager had a diversified basket of 5 different hedge funds with 5 different strategies of quantitative trading, long-term, macro, etc. And he was confident that he could easily outperform the S&P 500. It's worth noting that this bet was taking place during the Great Recession. Warren Buffett's stock pick lost 34% in 2008, and it lost a whopping 54% in March of 2009, and the hedge fund was winning. So some of you may be like, oh no, he's going to lose his bet. Don't worry, relax. They don't call him the Oracle because he's some dumbass army guy. And if by magic the share price started to increase, was Warren Buffett really an Oracle? Could he really see in the future? Don't worry, we'll get to that. After 10 years, the bet was over. And the winner was, drum roll please, and still the undisputed champion of investing, the Oracle, Warren Buffett. Now, there's also a good side to this story. He gave his winnings to Girls Inc., a local charity in his area. Now, let's have a look at the results. Warren Buffett shares gained 125% over 10 years, while the hedge fund's results was only 36% over 10 years, which gives us a very clear-cut winner. Now, you may be thinking, wait, how did he win? What was the share he picked? You may be thinking, wait, how did he win? I thought hedge funds were really good at beating markets. Well, I'm going to explain how he won now. First off, hedge funds rely on people not having any information. They use the Wizard of Oz technique of hoping people don't look behind the curtain. Now, most hedge funds only last about 5 years. And also, 1 in 3 hedge funds fails on an annual basis. And it's something like 98% of hedge funds don't beat the market in the long term. So it's only a small percentage of them that do. Now, the share Warren Buffett betted on it's not really a share per se. It's called the S&P 500, and it's an index fund. Basically, how this share works is it's made up of the top 500 companies in America, and this strategy will be known as passive investing because basically you're not doing anything, whereas hedge funds will be known as active investing, which over the long term loses against passive investing, which I'm going to talk about. Now, the S&P 500 index fund was created by John C. Bogle and his company Vanguard. Now, in 1971, he was an undergraduate in Princeton University. His thesis was basically about how hedge funds did not earn any more money than if they were invested in a broad stock market index. And even if the hedge fund did beat the index, it reduced investors' return to below that benchmark because basically they're too expensive. So even if, say, for example, the whole market as a whole is up 10% and the hedge fund is up 12%, they're probably charging 4%. So that actually brings your total return down to 8%. And as Warren Buffett's bet proved, this is still the case today. The average annual return for the S&P 500 index, including dividends, since it was created, has been about 10%. In some years, like 2008, it obviously lost money. On average, it returns a total of 10%. For example, in one year, it might lose 20%, but in the next year, it might return 40%. And it's been proven time and time again from many different books on investing and from investors that in the long term, only a small percentage of people can beat the market. A way of thinking of this index fund is you're betting with the market, not against. And the S&P 500 index fund has been recommended by a lot of people: Warren Buffett, John Bogle, and Tony Robbins. And these people recommend this fund for people who want to invest in the stock market for the long term and get good returns. Some of the reasons this index fund does so well is not only is returning 10%, it's much lower cost when compared to a hedge fund, and it's also more tax effective. Now, for people outside the US, you may be better off investing in an ETF, SP 500, as this may be more tax effective for you. And this is something to look up yourself. You definitely do have to do your homework with this, and I can explain it in another video. Basically, an ETF is an exchange traded fund, and it basically tracks an index fund. Now, Warren Buffett's advice to normal people wanting to invest is: the goal of a non-professional should be never to pick the winners. His strategy for normal people is to put 10% into short-term government bonds and 90% into a very low-cost S&P 500 index fund. He suggests Vanguard. I would suggest them as well. And he believes that in the long term, they will produce superior results than those employed by high-fee managers. And look, as his bet has proven, he's right. He's a man who's put his money where his mouth is. Now, I hope this video has really shown you that investing isn't just for the elites, and that investing isn't about picking the right shares and being lucky. It's about just having a simple strategy and just sticking to it. Now, thank you for watching. Please like, comment, and subscribe, and see you next time on Young Wolf Media. Thank you.